Tesco's UK like-for-like sales grew 1.8% in the 13 weeks to the end of May, less than half the 4.2% posted the prior quarter, and below the city's 2.3% forecast. The share price fell 2.6% on Thursday. What makes that reaction instructive is what it was not reacting to. Tesco simultaneously reported its highest UK grocery market share in more than a decade, at 28.3%. A company that just extended its lead over every competitor it faces, yet the market sold the stock. The provisional answer lies not in the sales number itself, but in what the gap between market share and revenue growth reveals about the UK consumer's wallet. When volume share rises but spending per basket stagnates, share gains stop being a positive signal. The mechanism is straightforward. Tesco is capturing more shopping trips through price matching on Aldi lines and club card personalization, but the consumers it is attracting or retaining are spending less each visit. Online sales grew 8.9%, which is strong in isolation, but the digital channel structurally carries lower basket sizes and heavier fulfillment costs than in store. Group sales rose only 1% to £16.8 billion. The market share headline is the result of a trading strategy designed for a cost of living crisis. Deep price investment, Aldi price match extended to 2,000 express stores. That strategy wins footfall. It does not recover margin. The CEO, Ken Murphy, pointed to two culprits: a wet spring against last year's exceptional sunshine, and the Iran war created ongoing uncertainty for many households. Both were real, but Murphy's own framing contained a contradiction he did not resolve. He said the weather was the biggest impact on the market, yet also stated plainly that there is no doubt that the war in the Middle East is impacting consumer sentiment. Two causal stories, same data, opposite implications for whether Q2 recovers. The tension in Tesco's report is structural, not seasonal. UK grocery inflation at Tesco ran at 2.2% during the quarter, below the official ONS rate and below wage growth. In a normal environment, that would be the setup for a volume recovery. Real wages positive, inflation below trend, consumers with headroom to trade up. Instead, comparable sales growth halved. The reason is that the Iran war's transmission into UK households is not through food prices directly, but through petrol and energy anticipation. Petrol prices rose on Middle East conflict fears. Household energy bills are expected to rise later in the year. Consumers are not seeing higher food bills yet, but they are preemptively pulling back on discretionary grocery spend: the celebratory basket, the barbecue top-up, the premium tier. Tesco's finest premium range grew 9% during the quarter. That sounds contradictory, premium up while volume softens, but it is consistent with a bifurcated consumer base. The higher income segment trading within Tesco on quality, the price-sensitive segment consolidating their shop at Tesco through the Aldi price match, spending the same or less per trip. The split means Tesco is simultaneously winning in two segments, while the aggregate top line disappoints, because the mix shift offsets volume gains with smaller baskets in the value tier. This is the hidden assumption in the market share thesis that analysts have largely left intact, that volume share growth will convert to revenue growth as conditions normalized. Jeffries noted that on a two-year stack, UK LFL was up 6.9%, implying the business held last year's gains. Short Capital's Clive Black argued fresh food up 3.6% and finest up 9%, pointed to customers still spending on quality. Both readings treat the miss as a base effect artifact. What neither addresses is whether the weather recovery assumed in that base effect will arrive before the Iran war's energy cost transmission arrives, and those two timelines are now in direct conflict. The number that breaks the base effect offense is not the UK retail LFL figure. It is Booker, Tesco's wholesale arm, which supplies independent retailers and catering businesses, recorded a 3.2% revenue decline in Q1, steeper than the 2.1% drop reported in the Christmas period, and driven by weakness in sales to hospitality and high street catering clients. Booker is the forward sensor for the UK's out-of-home spending environment. Independent food retailers and caterers are the channel that captures consumer discretionary spend outside the home. When Booker falls, it is not weather. Hospitality operators are not buying less stock because it rained. They are buying less because their own customers are visiting less frequently. Tesco management attributed part of the Booker decline to the deliberate exit of a lower margin contract, a one-off factor that makes the headline look worse than the underlying trend. That is a plausible mitigation. But even stripping out the contract exit, the direction is deteriorating quarter on quarter. The tension for investors is that the retail segment and the wholesale segment are reading the same consumer differently. The retail business sees footfall gains and market share expansion. The wholesale business sees demand contraction from the operators who serve that same consumer in a different setting. A consumer who is spending more carefully is not cutting their supermarket shop. They are cutting the meal out, the takeaway, the pub visit. Booker captures that cut. The $3.0 billion to $3.3 billion profit guidance maintained for the full year implicitly assumes Booker stabilizes. If the Iran war's consumer confidence effect persists through summer, that assumption requires a second look. Jefferies noted that investors will focus on whether Q1 was the low point for trading momentum and whether a margin upgrade is possible at the October half-year results. The answer to both questions is the same variable. Does the Iran war's consumer confidence shadow lift fast enough to allow Booker volumes to recover before autumn?
The U.S.-Iran peace deal, signed earlier today and reopening the Strait of Hormuz, removed the immediate tail risk that was embedded in consumer sentiment during Q1. Petrol prices are falling as we speak, Murphy said Thursday morning, and the deal raises hopes that household energy bills, which were flagged as a risk for later this year, may not materialize at the level feared. That removes the dominant fear driving the cautious shopper behavior Tesco recorded. On that reading, Q2 to be structurally better. Iran fears dissipated, a warm summer base effect reversal, World Cup providing incremental grocery spend uplift. But the peace deal removes a fear that had not yet translated into changed shopping behavior. Murphy was explicit on this. It's more the fear and the anticipation of what might happen than what's actually happening. The Bank of England, holding rates at 3.75% today by a 7-2 vote, confirmed the same read. Global energy prices have fallen since the prior meeting, but inflation risks remain in the pipeline. The BOE held, not cut. That signals the monetary authority sees residual inflation risk in the system that a peace deal does not instantly resolve. The energy cost transmission has a 6 to 12-month lag. Removing the geopolitical trigger today does not remove the already embedded cost pressures moving through supply chains. The counter-evidence that deserves a direct confrontation. Tesco's full-year profit guidance of $3.0 billion to $3.3 billion was reaffirmed with qualification. Charles Stanley's Gary White why bat as management confidence in balancing competitiveness with profitability. That is not dismissible. Tesco has $341 million of a $750 million buyback already completed, and its cash generation through the cycle has been consistent. The holder's case rests on guidance credibility. For holders, the single variable to watch before acting on that credibility is October's half-year results, specifically whether Booker Wholesale posts any stabilization and whether UK LFL recovers toward the 2.3% analyst consensus missed in Q1. A Booker decline that weakens to -4% or beyond in Q2 would signal that the consumer confidence drag outlasted the Iran war fear, which the guidance does not assume. For the watch list candidate, the entry trigger is not the peace deal. It is evidence that Booker's catering clients are restocking. That data arrives through industry channel checks before October. The peace deal closed the geopolitical chapter. The economic chapter is still being written. Every day after the close, we publish a market wrap and key issue analysis. Subscribe to the channel.